On November 3rd, 2025, the Chinese Ministry of Commerce issued Announcement 2025-68, a single document, 47 pages of technical requirements, export licensing protocols, compliance thresholds. The financial media barely noticed. Analysts dismissed it as procedural. Traders kept trading. And while the world slept, China just detonated a nuclear bomb in the global silver market. Today is December 16th, 2025. Silver is trading at $63.91 per ounce, up 113% year to date. And what I'm about to tell you will make you understand why this is just the beginning, why COMEX is on the verge of complete structural collapse, why the paper silver market that has controlled prices for decades is about to separate from physical reality, and why $100 per ounce isn't optimistic, it's conservative. This is the story of how China just broke the silver market forever. The export restriction. Nobody saw coming. Let's be very clear about what happened. China didn't ban silver exports. That would be too obvious, too aggressive, too likely to trigger immediate international retaliation. What they did was far more sophisticated, far more devastating. They implemented a state trading management system for silver exports covering 2026 through 2027. Sounds boring, sounds administrative. It's actually a masterclass in economic warfare. Here's what it means in practice. Starting January 1st, 2026, only companies that meet extraordinarily strict qualification criteria can export silver from China. You need to produce at least 80 tons of silver annually. 80 tons. That's 2.57 million ounces. You need ISO 9000 and ISO 14000 certifications. You need bank credit lines of at least 200 million yuan. You need to prove export performance in every single year from 2022 to 2024. You need full compliance with social insurance payments and environmental regulations. And even if you meet every single requirement, you still need government approval for each shipment, a license that can be delayed or denied for any reason. This is not a free market. This is a controlled choke point. And China just turned the valve. Well, why does this matter? Because China accounts for roughly 15% of global silver production. But here's the critical part that everyone misses. China also absorbs over 50% of industrial silver demand. Their solar panel industry alone is consuming silver at a rate that would terrify any supply chain analyst. Their electric vehicle sector is scaling exponentially. Their electronics manufacturing is the largest on Earth. They need every ounce of silver they can get. And they just stopped sharing. In October 2025, right before these regulations were announced, China exported a record 660 tons of silver. 660 tons. A massive surge. Why? Front-loading? Chinese exporters knew the restrictions were coming. They knew Western markets were desperate for physical metal. They knew COMEX and London vaults were depleted. So they shipped everything they could before the door slammed shut. That silver flooded into Western warehouses. It temporarily relieved bottlenecks in London and New York. Traders breathed a sigh of relief. COMEX registered inventory ticked up slightly. Everyone thought the crisis was over. They were wrong. That wasn't relief. That was the last shipment, the final supply dump before China goes dark. Because starting January 1st, 2026, that flow stops. And Western markets that have relied on Chinese silver exports to paper over structural deficits for years will suddenly face the reality they've been denying. There isn't enough silver. There has never been enough silver. And now the biggest potential source of supply just left the market. The COMEX delivery nightmare. While China quietly strangled supply, something unprecedented was happening at COMEX, the Chicago Mercantile Exchange, the heart of paper silver trading, the place where prices are discovered through futures contracts that almost never result in physical delivery. Historically, less than 2% of COMEX contracts stand for delivery. The rest roll forward or settle in cash. It's a system built on the assumption that physical demand will remain negligible. That assumption just shattered. In the first 4 trading days of December 2025, over 47.6 million ounces of silver were claimed for physical delivery. 47.6 million ounces. That's more than 60% of COMEX's total registered silver inventory. In 4 days. Let me repeat that because it's almost incomprehensible. In 4 trading days, 60% of deliverable silver vanished from COMEX vaults. This has never happened before. Not in the Hunt Brothers squeeze of 1980. Not in the 2011 spike. Never. What's registered silver? It's the metal sitting in COMEX-approved warehouses that is available for immediate delivery against futures contracts. It's the foundation of the entire paper trading system. When that metal gets claimed, it transfers to firm hands. It leaves the system. It can't be used to support short positions. It can't be leased out. It's gone. And COMEX just lost 60% of it in 96 hours. Veteran precious metals broker Andrew McLeod raised an eyebrow-raising possibility. On December 4th, 2025, COMEX experienced what officials called a cooling system failure that halted trading. A cooling system failure. In a state-of-the-art data center that supposedly has multiple layers of redundant cooling, that supposedly can't fail. McLeod, citing commentary from engineers familiar with major data center operations, suggested an alternative explanation. What if they didn't have a cooling failure? What if they just pulled the plug? What if the delivery pressure was so extreme, the standing orders so massive, that the exchange needed an emergency pause to figure out how to handle the crisis? Before the blackout, there were 36 million ounces of stand-for-delivery orders waiting in the system. 36 million ounces, roughly 30% of the COMEX free float inventory. And remember, this happened right after China's record October exports hit the warehouses. The timing is suspicious, the explanation is convenient, and the pattern is terrifying. Because here's what nobody is saying publicly. COMEX doesn't have the silver. They thought they did. The inventory report said they did. But when actual delivery requests exceed historical norms by 30 times, when sophisticated institutional players start demanding physical metal instead of rolling contracts, the entire fractional reserve system breaks down. And we're watching it break down in real time. Total COMEX vault inventories have declined by over 73% since 2020. 73%. For years, that didn't matter because delivery rates were negligible. But now delivery demand has exploded while inventory has collapsed. It's a mathematical disaster. On December 9th, 2025, 7,330 silver futures contracts requested physical settlement in a single day. That's 36.65 million ounces, roughly 30% of the remaining COMEX deliverable inventory. In one day, analysts like Andrew Maguire are predicting that silver could soar to $80 per ounce or higher as COMEX's price control mechanisms completely break down. The exchange is facing a choice. Either deliver physical metal they don't have or start forcing cash settlements. If they force cash settlements, the entire purpose of the futures market evaporates. Because futures contracts are supposed to be tied to physical delivery. That's what gives them legitimacy. That's what allows price discovery. If the paper and physical markets separate, if COMEX can no longer guarantee delivery, then paper prices become meaningless, and physical prices go to the moon. Shanghai is already there. Shanghai Futures Exchange inventories fell below 500 tons in November 2025. 500 tons, that's 16 million ounces. For context, China's industrial demand alone is consuming thousands of tons per year. The Shanghai market is bone dry. And with export restrictions kicking in January 1st, that silver isn't coming west. It's staying in China. Feeding their solar industry, powering their EV sector, supporting their electronics manufacturing. London isn't much better. The London Bullion Market Association has been experiencing extended delivery timeframes for months. What used to take a few days now takes several weeks. Lease rates are spiking. Borrowing costs for physical silver have surged. These aren't normal market conditions. These are symptoms of a market in crisis. A market where physical metal is becoming genuinely scarce. Where paper claims vastly exceed available inventory. Where the entire structure is held together by hope and leverage. The perfect storm converges. Now let's zoom out. Let's see how all these pieces fit together. Because what's happening isn't a series of isolated events. It's a perfect storm, a convergence of forces that's about to rip the silver market apart. First, you have structural supply deficits. 5 consecutive years where global demand has exceeded global supply. The 2025 deficit is projected at 117 million ounces. Since 2021, the cumulative shortfall is approaching 800 million ounces. That's 10 months of global mine production. Gone, consumed, never coming back. And the deficit isn't shrinking. Industrial demand keeps accelerating. Solar panel production is exploding. Electric vehicles are scaling to mass production. Artificial intelligence data centers are consuming 1.2 kilograms of silver per server rack. 5G networks, medical devices, electronics. The demand is relentless. Second, you have supply that cannot respond. Global mine production in 2025 is estimated at 813 million ounces, virtually unchanged from 2024. Why? Because roughly 70% of silver comes as a byproduct of mining other metals, copper, zinc, lead, gold. When you mine those metals, you get silver whether you want it or not. And when prices for those base metals don't justify expansion, silver supply doesn't grow, no matter how high silver prices climb. Mine production peaked in 2016 at 900 million ounces. Since then, it has declined by an average of 1.4% per year due to reserve depletion, mine closures, and ore grade deterioration. Even with silver up 113% year to date, production isn't increasing. Third, you have China restricting exports. 15% of global production, 50% of industrial consumption. And now, starting January 1st, 2026, exports will require government licenses that can be delayed or denied. The October surge of 660 tons was the last gasp. After that, the flow stops. Western markets that have relied on Chinese supply to fill gaps will be on their own. Fourth, you have COMEX facing delivery stress that's unprecedented in modern commodity market history. 60% of registered inventory claimed in 4 days. Trading halts blamed on cooling failures. Delivery timeframes extending. Lease rates spiking. The fractional reserve system that has controlled silver prices for decades is breaking down. And when it breaks, the price discovery mechanism shifts from paper to physical, from leverage to scarcity, from manipulation to reality. Fifth, you have governments waking up to strategic importance. On November 8, 2025, the United States Geological Survey added silver to its list of critical minerals. Critical, strategic, essential to national security. Why? Because without silver, you cannot build solar panels at scale. You cannot manufacture electric vehicles. You cannot construct 5G networks. You cannot power artificial intelligence infrastructure. Silver isn't just a precious metal anymore. It's a strategic energy metal, and the United States government just admitted they're vulnerable. This is happening while President Trump is considering Section 232 tariffs on silver imports. Section 232, that's the national security provision, the one that allows the president to impose tariffs or quotas on imports that threaten national security. If silver gets hit with Section 232 measures, the message is clear. America needs silver. America doesn't produce enough silver, and America is willing to use trade policy to secure supply. That's a game changer. That's an admission that silver scarcity is a national security issue. And here's the kicker. While all of this is happening, investment demand hasn't even kicked in yet. 2025 saw massive inflows into silver-backed ETFs, approximately 187 million ounces by early November, an 18% increase. But retail coin and bar demand actually fell in 2024 to a 5-year low. Western retail investors thought silver was expensive at $30, at $40, at $50. Now it's at $64, and they're paralyzed. They missed the run. They're waiting for a pullback that might never come. But institutional investors, they're awake. Bank of America raised its 12-month silver target to $65. Citigroup is forecasting potential targets of $95 to $100 within the next 12 to 24 months, based on sustained industrial demand and physical shortages. The gold to silver ratio has collapsed from 90 to 1 down to around 69 to 1 as of mid-December. Historically, when that ratio gets this compressed, it tends to snap back violently as silver catches up to gold, and silver is catching up fast. The endgame. When paper meets reality, here's what happens next. And this isn't speculation. This is logic. This is math. This is physics, meeting economics. China's export restrictions kick in on January 1st, 2026, 13 days from today. Western markets will immediately feel the loss of Chinese supply. COMEX inventories are already critically depleted. London vaults are stressed. Shanghai is empty. There is no cavalry coming. There's no hidden stockpile waiting to flood the market. Industrial buyers need physical silver, not futures contracts, not cash settlements, not paper promises. They need actual metal. Solar panel manufacturers can't build panels without silver. Electric vehicle producers can't manufacture battery systems without silver. Electronics companies can't fabricate circuits without silver. These are hard physical requirements. When COMEX can't deliver, when London delays shipments, when Shanghai has nothing to offer, industrial buyers will be forced into the spot market. They'll pay whatever it takes, because the alternative is shutting down production. And shutting down production means zero revenue. When industrial buyers start bidding against each other for limited physical supply, prices don't go up linearly. They go up exponentially, because silver isn't optional. There are alternatives: gold, platinum, palladium, but silver would need to reach a 1-to-1 ratio with gold before those alternatives become economically viable. Gold is trading around $4,000 per ounce. Silver is at $64. Silver has a 62 to 1 upside before substitution even becomes possible. That's not going to happen overnight. But directionally, silver has room to run that most people cannot fathom. And here's the psychological shift that's about to occur. Right now, traders still think in terms of paper prices. They watch futures contracts, they track ETF flows, they analyze technical charts. But when the paper and physical markets separate, and they are separating right now, the mindset changes. Physical silver holders realize they have something that cannot be printed, cannot be leveraged, cannot be manipulated by exchange rules or margin requirements. They have actual atoms of silver. And those atoms are needed by industries that generate trillions of dollars in revenue. The scramble is about to begin. China has already secured their supply by locking down exports. They're prioritizing their own industrial complex. Smart, strategic, ruthless. Now, Western manufacturers, Western governments, Western investors are going to wake up to the reality that they're late to the game. That the silver they thought would always be available isn't available anymore. That the price they thought was expensive was actually cheap. This is not the top. This is the starting line. Silver at $64 isn't expensive, it's mispriced, it's undervalued relative to the physical reality of supply and demand. It's cheap compared to what's coming. The 5-year structural deficit, the Chinese export restrictions, the COMEX delivery crisis, the industrial demand explosion, the strategic government recognition. These aren't temporary factors. These are permanent structural changes to the silver market. $100 per ounce isn't a prediction. It's a mathematical inevitability when you have demand exceeding supply by 117 million ounces annually, when you have the largest exporting nation restricting shipments, when you have the primary price discovery exchange running out of physical metal, when you have industries that require silver to function bidding against each other for limited supply, the price has to rise. It has no choice. And $100 might be conservative. Citigroup is talking about potential scenarios reaching $100. Some analysts are whispering about $150, $200. If the paper market completely breaks, if COMEX forces cash settlements, if physical and paper prices diverge permanently, there is no ceiling. Because industrial buyers need the metal, and they'll pay whatever it takes to keep production running. December 16th, 2025. Silver is at $64. China's export restrictions begin in 13 days. COMEX is hemorrhaging inventory. The endgame has started, and everyone who said this was the top, everyone who said silver was expensive, everyone who told you to sell, they were catastrophically wrong. This isn't the end of the rally. This is the beginning of the greatest silver squeeze in modern history, and the world is about to learn what happens when paper promises meet physical scarcity. The lesson will be expensive, very expensive, unless you're already holding physical silver. Then it's going to be very, very profitable.